this is what I've been looking for, right? I can create a portfolio. I can finally create a portfolio that is truly diversified, that is using everything that we know we can use. So that means not only assets, but also strategies. We can try to balance those things out. It's going to be a great long-term Sharpe ratio portfolio. It's going to be stable. It's going to be all weather. And then we can get it to the volatility that people actually want, right? And if they want an 8% volatility portfolio, we can do that without losing balance. If you want a 12% volatility portfolio, we can now do that, and it's not losing balance, right?
Hello and welcome to the Get Stacked Investment Podcast, where we delve into the exciting new world of return stacking. Join us as we break down complex financial concepts into accessible insights, speak with leading experts in the space, and analyze real-world applications for return stacking. Get Stacked is here to help you break out of the traditional portfolio construction mold and get you to start thinking differently about the path to successful investing.
Corey Hofstein is the co-founder and chief investment officer of Newfound Research, and Rodrigo Gordillo is the president and portfolio manager of Resolve Asset Management Global. Due to industry regulation, we will not discuss any funds managed or sub-advised by these firms on the podcast. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinion of neither Newfound Research or Resolve Asset Management Global. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of these firms may maintain positions and securities discussed in this podcast. For more information, visit returnstack.com.
Hello, and welcome everybody to another episode of the Get Stacked Investment Podcast. Today I have a very special guest, a friend of mine and colleague, Rafael Ortega, which is a Spanish investor, not from Latin America, but from Spain. And he is currently a senior investment fund manager at Andbank Wealth Management, where he manages a bunch of portfolios, including permanent portfolio ideas, all-terrain, return stacking, and kind of what he calls the off-road investor approach, which are custom-built portfolios for institutions and high net worth individuals. Yeah, this is a interview that I've been wanting to have for a while now. I'm also been doing his podcast in Spanish called The Off-Road Investor for over a year now, right?
A year and a half, I think.
Yeah, and I struggle a little bit with the nomenclature in Spanish when it comes to our industry, and I'm sure Rafa is going to go through the same. It's my turn to make him suffer a little bit and do it in English, but
it's payback.
I figured that it would be a great time to bring him on board, because I think, broadly speaking, when we talk about return stacking and the way that we've really garnered attention is how do people stack returns above a 60-40 portfolio or an 80-20 portfolio or 100% equity plus portfolio. But and then you get into, okay, what else can we do with return stacking? Maybe there's a more balanced approach to building a portfolio, and you get to an all-terrain approach. But Raf actually came the other way around. He started, when I met him anyway, he's going to tell us his background. But when I met him, he actually had already started thinking about the concept of a balanced portfolio, and then built himself into all-terrain. And now he's thinking about, in the latest iterations, of doing 60-40 plus or 100 plus. So yes, he is a fantastic partner. He actually has taken the Return Stack Portfolio Solutions moniker and on our behalf started creating the brand in Spain. So we'll talk a little bit about that. But before I get into all of the fun stuff, I do want the audience to get a bit of a background on you and how you started as an engineer and ended up in return stacking portfolio solutions. So maybe give us a broad overview of your history.
Okay. Well, first of all, sorry for my English. I all the investing information I consume is in English, but then I never speak about investing in English. So I'm sure some of the words are not going to come, and maybe Rodrigo can help, as I've been helping him in Spanish. The thing is, I started not as an investor, right? I did engineering. I thought I was going to be some sort of consultant. And I actually started in one of those big consultancy firms as an analyst. But that lasted only a couple of months because then I was studying and living in Madrid, and my family is from Valencia. That's another city in the east of Spain. And my my mother used to run a small business, and then she was sick and went on a like sort of a depression. The business was in a crisis, and I felt like the prodigal son that had to come back and do something about that. I have a younger brother; he was still studying, and my father had recently passed away. So we were going through a huge family crisis, and we solved it eventually. And then at that point, I was looking at, like any family and any business, what do you do when you make more than you consume? So what do we do with those savings? But obviously I was youngish, like 20 something, but I was looking at, you know, family money. I hadn't really made that. Also something that had taken a couple generations to build. um, I started looking online on like, what do you do when you invest? And everything I found was, trading, or oddly enough, in Spain, there's a huge value investing culture. So I got into, the Warren Buffetts and Benjamin Grahams and all of that. I also, had a look at what had been done in the past. And my mother used to work with a local bank. And very, very fast, I found that most commercial banks, well, first of all, in Spain, until now, most people just relied on their state pension. So, financial literacy is very, very low. And only the newer generations are starting to see that they will need to have some savings, right, for the future. So basically, everyone worked with their commercial bank, which just gives you closet indexed funds that are expensive. So, mediocre strategies, expensive, that's not going to take you anywhere. And I just couldn't find a solution that made sense for me, right? And I looked at a value investor. They would say they have these great marketing things, value is what you get, but price is just what you pay. And that sounds great. But if you've just gone through a crisis like I have just done, and if your savings are 50% down, it doesn't matter that you tell me that the value isn't down. The price is what matters when you need your savings, right? So most people, or at least my understanding of this was, most people need to balance out participating and protecting. You need both of those. And that to me is what makes sense to almost everyone. And I started looking at market history and other strategies, and I just didn't see it, right? I saw those 50% drawdowns. And then even if you have a theoretically balanced portfolio with stocks and bonds, those also go through huge drawdowns when there's inflation. And I just looked around and I couldn't see anything that I could believe in, right? Or that I liked. And I don't know how. Like, I just don't know how. I found Harry Brown and the permanent portfolio idea. And
You don't remember?
I don't know where I saw it the first time, right? I must have read a blog post or something, and that just clicked. I read it and I thought, okay, this makes so much sense to me. And for those who don't know, basically the permanent portfolio idea is that, we're going to have economic cycles. We're terribly bad at anticipating the next step of the cycle, or even if we know what's going to happen, we have to also have the timing right. It's just too difficult. But at the same time, we do know that different assets, and then eventually I found that different strategies also have this behavior. They behave in different ways in different environments. And that is something you can believe in, right? We know that's going to happen eventually. It's not in the short term, but in the medium term, that eventually happens. So you can map those. And the simplest version of this would be a portfolio that has something that works for growth, something that works for deflation, something that works for inflation, and then something that will work in a recession. Brown basically had stocks, bonds, gold, and cash, or invested cash. And so you have three assets that are, high volatility. That's 75% of the portfolio, 75% of the portfolio. They have low correlation between them. And then you have a buffer, which essentially is delevering that portfolio for you. So you have a conservative approach to investing that has low volatility, pretty good returns. It works in different market scenarios. I think what you're showing here is like, yeah, the different asset classes and what do we expect, right? But not only what do we expect, like what do we know is going to happen, right? The theory.
Yeah,
Right.
yeah, that's the thing. That's a kind of the key thing here, right? So what I'm showing here for those that aren't watching and listening is just the performance of some periods where we've seen inflationary stagnation, inflationary boom, deflationary bust, and disinflationary boom, which are just fancy names for when the intersection between high or low inflation shocks and positive or negative inflation shocks happen. And you can see clearly, right? And this is, I think, the big unlock when you get into this world is, okay, everybody wants to just do better, Warren Buffett value investing and throw in a little bonds just to reduce risk. But the reality is that a lot of retirees in the last few years that put 100% of their money in bonds have realized that even bonds have risk. And you don't have to have a lived experience that tells you that for then to modify your behavior. Before we saw the 2022 inflation shocks, you and I had already come to the conclusion that high inflation would be bad for both equities and bonds at the same time. But in this chart here just shows, inflationary stagnation. What you generally saw historically was commodities, gold, and in this case, trend following. We'll get to that, but Harry Brown is more traditional assets, right? More gold than anything. And then inflationary boom, which is high inflation accelerating growth. Everything kind of floats up, but the biggest winners are commodities and gold. Disinflationary boom, which is what our lived experience and most investors' lived experience has spent most of their time on, is high accelerating growth shocks and falling inflation. And that means, of course, that equities and bonds are going to do well. I think that's why the 60/40 has become so prominent. And deflationary bust is when you have a bear market and a negative growth shock and slowing growth without inflation, right? So that's generally equities down, commodities down, and then you see bonds really picking up the baton, trend following, and commodities, gold, bonds, and trend following getting hurt. So that's when you understand that framework, you're like, oh, okay, we need to think about my family's, in your case, right? It was my family's wealth going forward. And Harry Brown, basically, from what I understand, it was fairly simple. And the original idea is just
yes.
a quarter cash gold equity bond, right?
It seems, I mean, it's kind of so simple that it looks silly, but if you look at it from what I know now, actually the three assets are kind of risk parity equalized, right? Because it's gold, stocks, and long-term bonds, and those kind of have the same volatility, right? So you're actually doing like a risk parity from those three, and then the other one is just a buffer. It's just deleveraging the portfolio, so you have the conservative approach because he was trying to find a solution that anyone could do, and that it made sense for almost anyone. So the conservative approach to that made a lot of sense. Also, we can go on to that a little later, right? But if you only have stocks, bonds, and gold, there are still some times where those three can go down, especially through crises and shocks. And so we wanted something that would protect you even then, right? Something that was truly altering. And when I found that,
can I just pause there for 1 second? One thing that I think few people understand is when we say bonds, most people think about that aggregate bond index, aggregate bond portfolio that has generally speaking, has a duration of 6 to 7 years, volatility profile of 4 or 5%. And the key behind balance is making sure that the maniacs aren't taking over the asylum, right? That you don't want equities to be 4 times the volatility of your bond portfolio. And there's two ways of doing that: leverage, which we'll talk about in a sec, but more importantly here, if you go out the curve and the longer the duration, the more the volatility, therefore the bigger the impact when you need it the most, and the bigger the impact when you're getting hurt. But if it's balance and risk across equities and bonds, that's the way to do it. So when we talk about bonds here, we're really talking about long duration
bonds, right? Not
which nobody does, right? Because it's too volatile. Because bonds are supposed to be safe. They're not supposed to be volatile. Right. So, and it's so funny because
I started by
whatever you want.
Exactly. So I started my own personal portfolio, like for the company, for the business, or the family, however you want to see it. And it was a permanent portfolio. And I started talking about the permanent portfolio with different banks because I was trying to get those long-term bonds in that gold position, and it was almost impossible, right? And everyone looked at me like,
Really?
what, like 25%? Like what? Like they couldn't understand. And I started looking online and finding more people. Eventually I found you guys, and I found other all-weather solutions or altering solutions. But at that point in time, I was like my first aha moment where as we've said before, once you see it, you just can't unsee it. And I noticed that no one in Spain or in the Spanish internet world was actually talking about this. Like absolutely no one. And even in the Anglosphere, as I like to call it, you can find people talking about permanent portfolio ideas and all weather. It's there. There's more people doing it, and there's obviously like you guys and more people doing it. But it's not that it's not the standard, right? Like it's more of a niche thing. In Spain or in Spanish, absolutely no one was talking about this. So that sent me through double path. One of, okay, there's a business opportunity here. So this makes a lot of sense. It makes sense for me. There's obviously more people that it makes sense for. I need to learn more about this and get my license and become an advisor and start preaching this. And then on the other side, I need to, keep learning more and more about how to implement these strategies better and better. And that's how I found you guys. I found, Matt Favor with his Trinity approach. I actually found Corey. I found Ray Dalio and all of his pupils and all of those risk parity ideas. So I spent the last decade and a half reading and trying to see what people were doing in the space, and then trying to get my way through compliance teams and Spanish institutions to try to get these things backed so that investors in Spain can actually have a portfolio that does this. So
Yeah, being a trailblazer is not always fun.
yeah. Along the way, I built quite a community of people that believe in this, right? So when as you were saying, right, when you came up with that alternate paper or return stacking, anything I see, I start learning about trend following. Anything I see, I just see it from this structural diversification standpoint. I just can't see it any other way. Right?
Yeah, and I'll give you credit. I mean, you are. I always tell people that you're the Corey Hofstein of the Spanish investment space, because when you say you built a community, you really are an incredible writer and synthesizer of information. Even the stuff that we've written that we think we synthesize, when you take your take, when you have your take and your go, it is so much easier to understand. So kudos and credits to you for being able to do that for a community that has literally never heard of most of this stuff. At least in the US, it's wide enough, and Canada, that you can reach some people. I mean, you're starting from scratch. Every single person you're talking to has never heard about this, right?
Never.
And so I think you must have learned by slamming your head against the wall how to communicate with a community and create a pretty large one, as I see it.
Yeah,
right?
I think whenever I read your stuff, I feel like, okay, this is written for someone that knows what we're talking about. And I always try to water it down into the essence of it, because I'm usually talking to retail. In Spain, most funds are sold, right? People that invest with me buy my funds. They buy the idea and then they go into the strategy. I have no commercial team. I just do education, and people find our stuff. And if they have the similar, if they buy into the idea or the philosophy, then they eventually invest, or they do something similar and then preach it around, and then that gets other people, right? But that's basically what I've been trying to do. But always with that focus on that there's many things I don't know, but I do know that diversification works. and that the true diversification is what I think Adam is the first person I read that said structural diversification. And that just, again, I think one of the things that all-terrain, all-weather investors don't have is the same nomenclature. And I think that's something that value investors have and other investors have. And that brings a lot of those people together. And then that creates a community and that helps the ideas grow. So I like how, you guys have been interviewing people that are supposedly your competitors, but in the way I see it, they're not your competitor, right? Your competitor is, someone that's doing a index fund, robo advisor thing, or just like a highly active in the sense of stock picking strategy. We're doing something different, and we need to speak about it without trying to hide what we're doing. Like with the example of return stacking, I think it's very clear. I think the reason people buy return stacking is that you're actually saying what you're doing, and you're not scared of saying what you're doing, and you're not scared of defending the idea that you're trying to defend. It's tough because you're saying things like, leverage, managed futures. For me, especially every time I bring something to the table, like as you were saying, no one's heard of it. Like when I have to explain arbitrage or global macro or carry strategies, most of the time people are like, what, like a new thing again?
Yeah, we feel your pain for sure. And so, yeah, I mean, this is why communication and having the ability to synthesize things as well as you do is important here. But let's go back to, you have this interesting permanent portfolio approach and your evolution towards like where you kind of got stuck, and then how return stacking might have unlocked some value there.
So the thing is, when I started with a permanent portfolio for myself, but when I got the opportunity, I eventually became a financial advisor. That's when I got my first clients, and that I started to grow a base of investors that were interested in, adding something different to their portfolios, right? That's how I actually started. And eventually I got the opportunity to start a small fund. So I could build a strategy and people could go into the strategy instead of me, managing everyone's little portfolio. And I thought at the time, this was an error, by the way, but at the time I thought that most people wanted something that was not as conservative, right? The permanent portfolio's problem, and I don't think it's a problem. I think it's on purpose, but it's a pretty conservative strategy. It's conservative in many ways. It's conservative because it has low volatility. It's conservative because it's only using the biggest assets around, because Brown was thinking about something that, was fail safe. It wouldn't blow up. But there, he reached this, late 70s, early 80s, and eventually there's more things that we can do with our portfolio, right? There's more stuff going on now that didn't exist then, and that maybe you can bring into your strategy. And I was trying to find something that was more, I want to say balanced, but really, I mean, something that was equivalent to a 60-40, at least in most people's minds, right? Something that was medium risk. Well, let's call it medium risk. But yeah, something that was equivalent to a 60-40. And every time I tried to build a portfolio, design a portfolio that was matching 60-40 volatility, I was losing the balance, right? Because you have to have more stocks. If you have to have more stocks, then suddenly those stocks are running the asylum, as you were saying. Then if I add diversifiers on the other side, I get more tracking error, and then people are going to ask questions when those diversifiers are not working. So it was a tough challenge. I think I built a portfolio that it's still on. Now it's transitioning to a return stack version of the portfolio, but it's something that was, let's say, around 50% equities or 60% equities. And then the rest was an all-terrain defense, right? But if you want more volatility and you don't use leverage, the only way to do this is to get more stocks in. And then when stocks fall, your all-terrain defense is not gonna recoup all those losses. It's just going to be more, you have more trust on the fact that it's going to work better than just bonds, because bonds can also fall sometimes, and all-terrain defense is going to work more times. It's going to work against those stocks, but it's not really going to recover the loss that you got, right? It's just going to, what's the word? I'm looking for a word that it's not coming, Rodrigo, but it's like you're like diluting your risk in a more efficient way, but it's not really, you're not really balancing things out. That's just not. And every time I try to find ways into, okay, so maybe we get defensive equities, and maybe we do some, dual momentum thing on top. And I was just trying lots of things to find balance. And with traditional strategies, it's just, now I think it's just impossible. Like you're never gonna. You always have to take more risk in the form of cycle risk. And
so let me pause there for a second and just show an oldie but a goodie. We've been talking about this already, right? But this one just shows a chart of gold, global equities, commodities, and 10-year treasuries, right? Roughly speaking, I don't know, this is 1990 to 2023. Roughly speaking, they all make the same amount of return. But obviously the paths are wildly different, right? So which one do you want to choose is always the question. And from the perspective of risk balancing these, again, we talked about long-term treasuries are using the 10-year. If you run a simple equal risk contribution analysis to try to make sure that we balance things off, you're looking at 42% in treasuries, 29% in trend following here, 15% in global equities, 12% in commodities to get a 100% portfolio. And of course, the 10,000-foot view of that is that you get this smoothed out line that kind of crosses in the middle of everything, but actually slightly outperforms over the long term, mainly due to the rebalancing benefit, right? That diversification premium. Now, while this line looks amazing, right? Like I was trying to think about a different way of explaining to people, why is it that an equal risk portfolio is generally going to not provide the returns that a high risk portfolio like equities is going to provide? And the reality is that it's not true over many, many decades, right? If you think about the equity risk premium, right? What's the equity risk premium? Depends on, global equity risk premium. What is it? 3.5%, 4% above cash, right? So it's a notional, we're looking at 6% annualized, right? Term premium is, 2-3%. When you actually look at all of these returns, they all at the end, as we can see from this graphic, roughly make the same return. The problem is that by diversifying, you're clustering that return around that long term more often. And sadly, a 60-40 investor and 80-20 investor tends to see more double-digit years than you do when you're balanced. And that's painful. And that reduces risk and reduces, long-term returns. You have to wait a long time to be able to say, okay, we did it. We did the same or better than with lower risk. And the reality is that it's boring for most people. When you create this portfolio and you have a 4% volatility portfolio, you're constantly apologizing for not putting enough risk on. And the reality is that you're kind of, up until recently, you were limited as to what you could do in terms of giving people what they wanted, which is, look, I'm used to a standard deviation in my portfolio of 12%, 15%. Like I'm okay with that. I'm okay with the drawdowns that I've seen. Can you give me that? And the answer was no, right? The answer was no. You get this. This is the maximum balanced portfolio you can get. And so anyway, I thought I'd kind of pause there and show people.
Can you keep it there for a second, Rod, that graph? Because I love it, because it makes so much sense, and then no one likes it in real life. Because in real life, I like to sometimes show this, and people will always choose that dark blue line, but then show it starting at 2010. And then that just goes flat, great risk return, great Sharpe ratio, but it's just boring. It just gives you a couple percentage points, while some of the other strategies in this exactly that point in time, it's going to be stocks, are giving you those double-digit returns and incredibly high Sharpe ratios. And it doesn't matter how many times you show this, people are going to be okay when they see it, And then after a couple of months of low volatility, low returns, they're gonna ditch it. It's just the way
Exactly.
it's just the way it is. And
And to their credit, if they feel they're leaving money on the table because they can take more risk, it's a
exactly.
problem,
So
right?
that's exactly the problem I was running into, right? I wanted to add more diversification because I knew it worked. I thought the portfolios were going to be more resilient, more all weather, and I was all in on that. But the more diversification you add, diversification works so well that volatility goes down, and the volatility goes down, eventually returns go down too, right? So then I wanted a bit more volatility and a bit more return, and I needed to have more stocks there. And then I was losing that balance. And then I was going back and forth between those two things, right? More volatility always meant that you had to sacrifice returns. And then when you had more stocks in, I was saying that I was all weather, but I wasn't all weather because I had 50 to 60% equities in my portfolio, right? There is
Right.
no way that a 50 to 60% equity portfolio is going to be all weather, because then you would need a leveraged defense, right? Something that was not just a mix of gold, bonds, and trend following and other alternative strategies. That was going to be an all-weather defense, but not an all-weather portfolio, right? That was the problem.
Yeah.
And then when you came up with the return stacking paper, that was my second aha moment where I saw it. I couldn't unsee it. I remember you guys did a live stream or maybe an episode, I'm not sure. And I went on the chat and asked, you were saying, how return stacking, we'll talk about this now, like how it can create some tracking error, whatever. And I think I said something like, okay, but what if you don't care about the tracking error? Let's talk about alternate. And I think, what are you like brushed it off a bit? Like, okay, maybe.
Yeah, because
That's
99% of our audience
99% of people
cares
are
about
not thinking about this. But
a few
after
lunatics like
after that
us.
is when I
Yeah.
emailed you like, okay, Rodrigo, we need to talk, because if I can do this, this is what I've been looking for, right? I can create a portfolio. I can finally create a portfolio that is truly diversified, that is using everything that we know we can use. So that means not only assets, but also strategies. We can try to balance those things out. It's going to be a great long-term Sharpe ratio portfolio. It's going to be stable. It's going to be all weather. And then we can get it to the volatility that people actually want, right? And if they want an 8% volatility portfolio, we can do that without losing balance. If you want a 12% volatility portfolio, we can now do that. And it's not losing balance, right? You're getting more risk, you're getting exposure, which is what you want, but you're not getting it through a concentrated cycle risk bet, which is what you do when you have a 50 to 60% equity portfolio, right? And I went crazy around the idea, and luckily a year and a half or something later, we finally did it, and we have portfolios on that can actually implement these concepts in Spain. So very grateful for that.
And I mean, most of the battle that I saw you fight is a battle that we fought originally too in Canada. Is you're not just fighting a battle of ideas, but you're running into operational roadblocks. Compliance teams don't want you to do X, Y, Z. Even platforms don't even have the capability of providing you what you want, or you being able to invest in US ETFs that use gold and stuff. Like, it's just been a constant struggle, and you've mostly kind of fought through all that. So tell us a little bit about that journey.
Yeah. So the thing is that, it's counterintuitive, right? I'm trying to say that I'm building something that is leveraged. It's 100% leverage, but it's actually a balanced allocation, right? And that goes against everything that everyone has heard or everyone that you get, everyone that's learning about investing will get that association, that more leverage means more risk, right? And to be fair, all else equal, leverage means more risk. But it all depends on what we're comparing, right? Because I think Also, everyone would understand that if you have like a very risky thing and a very unrisky thing, and sometimes you can leverage the unrisky thing and it will still be less risky than the risky thing. But the, um, the thing here is that I found that the solution to this problem is how you frame it, right? People think more leverage means more risk. The more leverage means that you're chasing higher returns. But that's not what we're doing, right? We're using leverage after we're diversifying. So the right order is you have a certain amount of risk. Now we're diversifying and we're adding true structural diversification to different assets and different strategies. So we're bringing volatility down. And because volatility is down, your returns are down. And we're using leverage to recover the exposure that you lost through diversification. So we're using leverage after we're diversifying. And again, this is another of the things that I think everyone in the world should be using. Because if you do the math and match the amount of added exposure so that it matches the added risk through added exposure matches the reduction in risk you get through diversification, you're doing that thing that what's the phrase? Eating your cake, or what is it?
You're yeah,
Eating it and having
you're
it toast,
having
right?
your cake and eating it too. Yeah, having your diversification cake and eating it
Exactly.
too.
So,
Yeah.
so that is the right order, right? We're reducing risk, and then we're using leverage to recover the lost risk. Right. Another way to see it is that you're actually this is okay. This is from a all-terrain point of view. If you look at this from a traditional portfolio where you have stocks and bonds, and then you're adding more diversification through stacking, that is defensive leverage. You're adding more defense to your portfolio. So if you do it right, and if you do that, most of the times you're not really adding that much risk. It comes with its what's the word? With its contrapuntos, or
Yeah, you can say counterpoints. It comes with its there's other offsetting things that happen when you use leverage, but not necessarily in the same way.
exactly. So you will have tracking error, right? It comes in the form of tracking error. It comes in the form of your volatility is going to be more stable, which sounds good until you see it live, right? That you're actually getting hurt very little, but all the time.
Yeah, more often, but
yeah, you feel it more.
yeah. So that's the thing I wanted to because we've chatted about this a lot, and this comes from Corey saying that risk cannot be eliminated. It can only be transformed, right? And so, how do you talk about that?
Again, I think the way to make people understand this is to do it in the right order, right? So the right order should be how much risk are you willing to take in the form of volatility, in the form of expected drawdowns, etc. Right? Once that is clear, then how do we take that risk, and how do we do it in the most efficient way? If you build a portfolio again that is just stocks and bonds, you're taking a lot of market risk. I've heard you say many times that when you look at the SP 500 and you use an ETF, that ETF is unleveraged. But if you look at the companies beneath the ETF and you look at the leverage within the companies in that ETF, you're actually using like 3 times leverage, right? If I remember right, something like that.
3 to 1, 4 to 1.
Exactly.
Yeah.
So you're taking market cycle risk, and we don't want to have that market cycle risk because that tends to crash eventually. Like once every whatever years, we will get into that part of the cycle where stocks just don't work and you get those big drawdowns. You want to take that risk, and that risk is the risk that you're diversifying, right? So you want to add other things that are going to move in different ways, ebb and flow in different moments, and it's the same amount of risk. But if you take the risk in smaller doses, the same amount of risk, it is much better than just feeling like there's no risk, which is how a 60-40 portfolio feels when everything is going your way. And then one day, you don't know when, it's going to come and it's going to hurt you. And there's a how do you say this in English? There's a asymmetry in the way returns come, right? With that idea that everyone understands, where 10% drawdown, you're back at zero with 11%, but a 50% drawdown needs 100%. So the same amount of risk,
Bring
the
back to you.
efficient way to take that risk is to try and do it in smaller doses. Smaller doses makes a lot of sense until you feel it when the other person is not feeling it, right? And that's what happened.
So you know what, Corey and I yesterday we're kind of looking at how to tell the story about this, right? This idea that there's risk in equities and there's risk in all terrain or equal. We're looking at an equal risk portfolio of assets. And so what I wanted to see is how often you're in drawdown in the S&P 500 on a daily basis, right? So how often are you hit a new high and started losing money versus how often you're in drawdown. I think we did trend following, we did gold. What's fascinating, there's a drawdown and recovery chart that we often use. I'll see if I can find it here later, but which is like you start losing money and then you recover. And if it's zero, it means you're making new highs all the time. So the top of the chart is flat as long as you're making new highs. And we're looking at trend following, and trend following is, could you guess how often on a daily basis the SocGen Trend Index is making new highs?
I would say very little, right? Because I feel it's like you're losing all the time, and then suddenly you get that big win. I think that's what.
Yeah, it's around 12% on a daily scale. It's around a third on a monthly scale. And when you look at the chart, when you actually look at the S&P 500, it is like making new highs. It feels, I haven't done the actual numbers, but it's flat. That chart of drawdown and recovery is flat most of the time. And then you have 2008 and you just lose and lose and lose and lose. And it's a massive drop, but you never see that in the history of the SocGen index. You never see that lose and lose and lose. You see drawdowns and recoveries, drawdowns and recoveries, drawdowns and recoveries. And so I think that tracking error.
So I was asking, even if you get it to the same level of volatility, so it's like it's structurally different.
It's structurally different. There's some, like, you're just getting more. It's the skewness of the S&P 500, right? And then you have the big fat tail. The moment you start adding diversification, you add bonds and equal risk, you add gold and equal risk, you add some diversifiers, you now have a more consistent like series of drawdowns every year, right? So you'll see you're like the area under the curve, for those that remember statistics, is roughly the same between a diversified portfolio and the S&P 500. It's actually less, but roughly the same. The difference is that area under the curve is showing up every year more often, and most of the area under the curve happens in big abrupt losses for the S&P 500. And so the experience here is something that is important, right? The experience is how often do you feel like you're winning versus your alternative portfolio.
I think I'm kind of lucky here in being able to communicate this, because I've been talking about the permanent portfolio for so long, and that is something that most people, I would say, in the investing community in Spain at least know about. Even if they don't believe in it or they don't use it, they kind of know about it because we've been talking like for a very long time. And sort of everyone knows that this is like an all-terrain solution, and they've seen how it behaves. It just behaves differently, right? Sometimes it's in a drawdown when the S&P or in Europe, most people use the MSCI World as the reference, but stocks are going up and this might be flat or going down because, I don't know, bonds are down or gold is down or something else is going on. So they're kind of used to this idea. And then from the permanent portfolio to a return stacked off-road portfolio, which would be like our most, I never say risky, I say it's just the most efficient portfolio. But our most efficient offering would be like a 12% volatility portfolio that is a mix of stocks, bonds, gold, and then trend carry and other diversifiers that would be smaller positions like Bitcoin or arbitrage or whatnot. And so they're kind of used to seeing that this thing is its own thing, right? The difficulty now is, explaining what trend following is, which again, I've been talking about this for longer, but maybe carry is something that people haven't been introduced to lately. And starting with a drawdown is never great.
It's always tough.
But they've seen, drawdowns in gold, and they've seen drawdowns in long-term bonds, which is something that everyone was saying, like, why do you have long-term bonds in the permanent portfolio? Why do you have gold? So we're used to explaining having odd things in the portfolio that everyone knows that you shouldn't have. But
yeah, right. Everybody knows that you shouldn't have right
exactly.
now.
Everybody knows. I've learned that two things, right? Diversification works. And the second would be that things happen and then the experts show up, right? It's always that way around. So yeah, never trust the experts.
Yeah. I don't understand why you own gold. It's lost nothing. It's lost money. Like, well, you should have known. Let's get out of
Also,
it.
now
Exposed.
it's getting the other way around, right? Like gold is an all-time high.
Why don't we buy more gold?
Why would you own 25% gold on your portfolio, or 20% out of 200 in an off-road portfolio? Obviously, you have to sell it. So,
yeah, and I have. Let's see if I can share this one here. Yeah, this is kind of from a brochure, the all-terrain portfolio. So we run a couple of model portfolios ourselves in the Return Stack website, returnstack.com website. But this is just an excerpt of the simplest all-terrain portfolio. I think it's levered 150%. It's basically all world, 7 to 10 year treasuries, gold, and the some commodities and a CTA index. And this is another thing that I think we get trapped into is I think the nomenclature is clearly appealing, this idea of all-terrain. But I think what it projects is never lose. And this is an important distinction. I think the idea of saying all-terrain is just a more efficient portfolio. You're still in a 4x4 going through some rough terrain and you will fall.
Yeah.
The issue is, are you going to get stuck in the ditch, right? And we've used a lot of imagery here on you and me when talking about the off-road investor and all-terrain. And I think the important thing is it is a 4x4. I think we can get out of most ditches. You don't want to be driving a Ferrari in this environment, right? And
you're driving
and this just kind of shows.
You're driving through the potholes, right? And when you drive through those, you're gonna feel it. Like if you've ever been in a 4x4 going through an off-road path, it's not driving, a Tesla to the supermarket. It's very different.
Yeah, that's right. And it really is, like when you look at the year over year here, you see that the all-terrain does experience shallower annualized losses and less of them, right? And you're getting the Sharpe ratio of this simple portfolio here is around 24 Sharpe points higher, so more efficient. For every unit of risk, you're getting more units of return. But in this case, the example here is to lever it up to the point where it has the same risk as a traditional 60-40 portfolio. All right. So the thing about this small edge is that over time, you see the value. Drawdowns are lower and so on. But in any given year, you're like, why are we doing this again? Like, it seems like we're getting the same returns, but it's a lot more complex to understand. And what I've found is that where this really becomes abundantly clear is when an asset class that people are overexposed to really goes through not a 2-month or 3-month, but a significant series of years, whether they're flat or down, where you see the value of all the other pistons in the motor doing well. And it doesn't always happen that way, right? Like what tends to happen is you have these shallow losses in gold and recovery, shallow losses in bonds and recovery, shallow losses in equities and recovery. And it just kind of chugs along and adds a little bit of value. It's super different. And then there will be a prolonged bear market in equities where you see the all-terrain, especially something like this, just kind of chug along positively. And that's when you see the value. So, it does take time to see the long-term value here, and it requires a lot of faith, right? And so a lot of education.
And also you have to be careful with the way you frame that too, because if we say that, I think I've said sometimes like the off-road portfolio kind of needs a crisis in order for you to see like a big difference, right?
Why you have it.
Yeah. But when you say a crisis, people are going to think, a 10% drawdown is a crisis or a 15% drawdown.
Right. Liberation
so
Day
you
drawdown.
need a really, really tough scenario to see that huge difference to appear, right? Because if not, you just see that it chuggles along at that level of volatility, and it can be doing that for, if I've run the backtest so I can see you can get maybe 4 or 5 years where it does kind of the same thing that a equally volatile stock and bond portfolio. And so the question there is, why am I using this expensive solution that is so complex when a very simple one can give you the same returns, right? And it's because you're in your backpack, you have a lot of things there that you just didn't need. That doesn't mean that you're not going to need them in the future. Like, the sensible thing is always to be prepared. You need to be prepared always. And, if we don't get a terrible market, I mean, I hope we don't get a terrible market, right? We're going to do okay too. It's not that bad. But yeah, sometimes I find myself thinking, like, do I want a terrible bear market for equities? So that people see the value of this. But yeah, anyone's...
Yeah, well, that's that. Yeah, don't we all? My anecdote to that is that I was doing this stuff in '08, and I remember the phases of emotions. Phase one, September, like Lehman goes down, September, October, I'm feeling so good, right? I've been talking about it for a few years. Portfolios are doing great. Everybody's losing their minds. Clients don't even know my clients didn't know, look, why is everybody so worried? Because they were looking at portfolios in a different light. And so the first was relief and satisfaction. We want that. And then you have January, February, and advisors aren't showing up to their desks. Associates are having to talk to clients that are crying on the phone. Family and friends are losing their jobs. Yeah. And then you're like, crap, I really need this to turn around right now. Right? It is a double-edged sword to kind of, I want to show the value of this, and this is important, but also I don't want to ever have to use those tools. I hope I never have to show you how important those tools were. I just need you to trust me so that when it does happen. And so by the end of it, I was just begging for things to change. And then when things changed, then the markets roared 80% and you're still making 9%, 10% a year, especially when it was non-levered, right? So it is, as an all-terrain provider and investor, you go through these emotions. At the end of the day, it comes down to, is it a sound, philosophical, fundamental investment strategy that works over time? And I think it's tough to, once you take the red pill, tough to say no, it doesn't. And even this year, I'm looking at just eyeballing the kind of the off-road portfolio versus an 80-20, right? 80-20 year to date is up again. And at a drawdown, around 13% drawdown, and in a recovery. And I'm looking at an iteration in off-road, roughly around the same risk, actually lower risk, but down less peak to trough and flat for the year. And they seem identical, but the reality is that one is a levered portfolio and the other one isn't, right? And the risk of, hey, it's a levered portfolio, that's risky. Again, if you're using defensive leverage, not so much. It had a shallower drawdown. It's now back to break even. And there were tools in there that the 60/40 didn't have, like gold, right? That really helped offset a lot of the losses on the levered side. And so the question is, what would have happened if this continued to go down 20, 30, 40, 50%? Would they continue to be in tandem like we saw in this shallow loss?
No.
And history has shown us that no, it becomes a very different portfolio in a continuation. But hopefully we'll never see that. Hopefully we'll just compete. Like, hopefully the all-terrain is able to compete. Hopefully all-terrain gives what people need in terms of what they care about, which is, am I going to have enough returns to make, to pay my bills when I retire, or grow to get a good retirement nest egg. But again, if it does happen, it's important to understand the moving parts and the value that they add if, God forbid, anything really bad happens.
So it's funny because I was thinking that's exactly what's taken me now full circle to, okay, I can't convince everyone to be an all-weather investor because some people are just not built in their mind for that, right? They like taking risks. They believe in stocks, and they're value investors or they're whatever. I don't know. They want stocks and they want businesses and they believe in the markets and they're capitalists or whatever they have in their mind. You still can use diversification without sacrificing returns, right? You couldn't do it before. You can do it now. And that's what I was saying, right? You can add to a 100% portfolio that, 100% stocks, whatever kind of thing you're doing, 100% stocks, you can add some diversifiers on top of that. And if you do the right amount, you're not going to feel the difference and you're just going to get that extra return from the stacking. So even if you're just looking at returns, return stacking makes sense. If you're looking at, maybe you want a little less risk and not concentrate your defense on bonds, then you can use return stacking to have a more diversified defense, which is what I was trying to do before, but now I think I'm doing it more efficiently again. We can add more defense to that defense that we didn't do that before with stacking. There's so many ways you can use stacking that when I put myself in other kind of investors' boots, my mind is exploding because I just can't understand. If you know about it, why wouldn't you do it? Like I just don't see a world where in a couple of decades this is the norm, right? Everyone will use
where it's not standard of care for the financial
everyone
industry.
Will be using 20. I see that, if you have any version of a 60/40, right? Like your indexed stock and bond portfolio, you can easily add 10-15% stack on that without affecting your overall risk and just get some extra returns from that. Like it will happen eventually. You're adding things that they make money over time. We know that, not all the time, but now you can get a diversified set of things that make money over time. You put them on top of your traditional portfolio. Tracking error is going to be minimal. Volatility wise, it's going to be almost the same, and you're just going to get some extra returns, right? Why wouldn't?
And the thing is, the caveat to all of that is that, we're saying it will, but the reality is that, you look at some diversifiers. AQR went through a 3-year period where their alpha sleeve just kind of lost money, and now it's killing it again. Like it depends on time frame. There will be losses. There's no guarantees, but again, these are sound. A lot of these are very sound ideas. Even if you're a 100% equity investor and you decide to stack some bonds, I mean, the question is term premium going to exist in the future? If you're able to stack an extra 1% just by doing 100% equities, 20% bonds. Now, you're adding diversification. Do you believe in term premium? Do you believe that bonds are going to make returns above cash, especially if you're taking duration risk? It seems like a reasonable thing.
I mean, any one of those can fit. I mean, I know we have to,
we have to, temper expectations.
We have to temper expectations. Yeah. I feel like that stock investors never do this, but okay, let's temper expectations. We will temper expectations, but I can see a world where one of those diversifiers can fail on you, even in the long term. But the more of them you add on, the more probable it is than a series of things that have made money over time in the long term. If you add them together and you have a diversified set of them, will eventually, very probably, make some money, and that will be something that will be on top of what you are doing right now, and it won't affect your portfolio, right? It makes so much sense.
And I think you're right. I think the big unlock for guys like you and me, who both started on the all-terrain camp, and we're like, this is the only way. When you take that away for a second and you see, okay, investing is a religion. Everybody has their own religion, and they're value investors, but there's a bunch of like sects within value investors too, right? And there's all terrain investors, and there's a bunch of sects. So everybody has their own point of view. The big unlock here is saying, okay, let's not try to shove all terrain down people's throats, but rather the realization that, oh, this is just a tool. And if we can provide tools for advisors and investors to apply their own religion in a much more efficient manner, then we should help them do that. And I think we've both later in our careers have been like, okay, you know what? Let's empower the world's population. You're going to tackle Europe. We'll tackle the Anglosphere, to just do a little bit better. And I think that's you're coming at it now. That's what you're going to start offering soon, and it makes total sense to me. And I'm actually quite pumped about it from this, how it's going to work in Europe from your perspective.
Yep.
All right. Well, we covered a lot. Is there anything that you think would be useful? Any parting words?
I had some notes in here. Yeah, well, maybe it's more of a question that I'm asking you, but
Sure.
I'm seeing more interest in return stacking portable alpha. The last couple of months have been pretty crazy with lots of shops opening up new ideas. Like, I understand there's one of the reasons why this hadn't happened before was had to do with the regulation in the States. We're looking at how this is evolving in Europe, but like, how do you see, first of all, the landscape in the States or in the rest of the world? You're doing
Sure.
some things in Canada too. How do you see this evolving in the States market?
Yeah.
I
I mean, like,
the transition to other markets like Europe, where I've started, as you were saying before, we found a way to offer it, but like we've had to go through many loops to actually be able to.
we're going through loopholes right now to get you the exposure that you
Today.
need with your bank, right? So it's, I think, like anything new, it's been around for 40 years, right? I think I've used this analogy before. There's a bunch of, for people who don't want to die of a heart attack, there's a bunch of tests that have been approved and been recommended for doctors to give their patients for years in order to assess whether you're a high risk for heart attack or not, that are not being done by the vast majority of doctors, even though they've been around for 20 years. And so it requires, in this case, some experts to kind of bang down the door and say, no, everybody needs to get their ApoB numbers, and everybody needs to get their LP little a numbers checked. And these are things that nobody really knows about today. They just care about cholesterol, total cholesterol, even though it's a good indicator, but not a maximum indicator. It takes decades, right? And portable alpha has been around for 40 years. And it's taken a few people, trying to say the same thing in different ways and communicate. And then when it becomes important, there's a groundswell right now. If you look at how many times the word portable alpha has been searched, it's gone from nothing to, an insane amount in the last 2 years, especially. Probably we helped in a little bit in that. And now institutions have to pay attention. Like, we know for a fact that Morningstar is having to think about a new category that's going to put all portable alpha people in there. And then the next question is, who's behind the curve? And I think the UCITS structures behind the curve, they have these weird rules about how one can invest in derivatives. And it makes it really difficult and really expensive to provide the best possible stack because of that. And I'm sure that'll slowly start to change, because there's going to be too many people that matter to them, forcing them to kind of lighten up a little bit. Right. So that groundswell's coming. People are asking more and more about it. Once a category in Morningstar, exists, and other platforms will have to think about it as well and categorize. There's a reticence from existing funds that have been using portable alpha from ever to saying the word leverage.
Exactly.
Right?
That's what I was going to say.
I think
now that I know it
destigmatizing is
exists,
going to be huge.
I see it everywhere, and now I know what it is, right? But before people were not saying it, right? You can find it, right? That you'll eventually find, this fund,
and
it's doing
the
this, but
goal
then
here
you
is
look
to
at what it's doing
destigmatize.
compared to a benchmark, and then you end up finding out that it's doing stocks plus something, and that's why they're getting those returns, right? So now that I see it everywhere, but I see people using it and not saying they're using it. And again, that going back to what I said before about being very transparent on, okay, this is what we're doing, and we explain it so that you don't get scared, and you see it's okay and it works, and this is exactly how it works. I think we're missing.
And I think a big unlock is also like anything, portfolio construction can be anything. Portable alpha can be any sort of iteration. Keeping it as simple as possible with the 1+1 that we've really focused on, talking about Lego blocks. I think, again, bringing it down to a level where people can understand it, understand what they can put in and what they can take out, and being upfront about what the stacks are is the big unlock versus how do you outperform? We just do overlay stuff. Just trust us. We're gonna just do our own thing, and you just need to, batten down the hatches and invest in it long term. We're trying to be like open kimono. Here's exactly how it works. You should know, and let's really understand what the risks that you're taking by using portable alpha return stacking leverage are, and dispel some of the myths and understand some of the risks. So it's going to be a long journey to get broad adoption. But like I said, 40 years from now, I'd be shocked if everybody's portfolio doesn't have at least a little bit of this.
That's how I see it too. Hopefully, Europe moves a little faster and I can introduce things, because right now I'm seeing that I'm always the first person to ask, or the first person in anything that is portable alpha-esque in Europe, now in Canada too. I think I'm one of the biggest investors.
Yeah.
So I'm trying to be there at the forefront of it, but I'm really enjoying it because I think we're very, very early, and
very early, and it's exciting. And you see that, like, when you put things together, and I'm like, oh my God, this is so good. We just need to we just need to show it out and give it some time. And it's always because of the operational burden of doing something new. It's always you're putting things out 2 years later than what you wanted to. Like, we wrote the paper in 2021 and we wanted to launch something at the end of 2021. Had we done that, the visual, obvious story would emerge. And what's happened is it took everybody 2 years to let us do what we needed to do. And we launched at the teeth of a drawdown in some of these stacks, right? So, we're just going to have to muddle through and keep on telling the story. And you're a good partner to have in Europe.
Let's see how it goes. We'll keep pushing it.
Rafa, this has been awesome. We should do this more often. Your English is much better than my Spanish, which is incredible for somebody that hasn't done this in English. Thanks again. We will, if anybody wants to find you, where can they find you on social media?
Well, I'm on Twitter mostly at River Patrimonio, which is RiverPatrimonio. We'll have it down there in the links, I guess. And then if you want to read about return stacking in Spanish, you can actually find if you look for return stack portfolios.es. That's the Spanish webpage, and there we're basically talking about return stacking and covering all the stuff that you guys are doing, trying to bring it again. I think the main difference is that we're looking at retail investors instead of advisors, so that's why I twist some of the ideas.
Yeah, I would definitely encourage people to go to the site, and there's a little button on your Chrome that says translate, and it does a pretty good job of just try to read a few and read it from a different angle that Rafa is really good at. So definitely visit the site, read some of the blog articles. We'll have you on more often.
Cool.
And keep doing what you're doing, man. You're doing God's work.
Great. Thanks, Rob.
Thanks for joining today.
If you're enjoying the podcast, please consider heading over to your favorite podcast platform and leaving us a rating or review and sharing us with friends or on social media. It helps new people find us and helps us grow. Finally, if you'd like to learn more about our extensive research on the concept of return stacking, please do head over to returnstack.com.